Welcome, everybody, to this month's edition of Mortgages with Millennials. We'll let some of y'all trickle in here in the waiting room for a minute, but I'm your host, Robbie Chrisman. Kristen, out today, conflict. She'll be back next month. We have some really exciting guests for you coming up this fall, but I'm definitely excited about our guests today. We have David Wells from Porchlight and Trent Hedge from Pylon Lending, and we'll get into kind of this future of mortgage, how we see things evolving, where efficiencies can be hammered out in the process, just kind of what the future of a digital transaction looks like, which for consistent listeners of the show or consistent listeners to my daily podcast, it's something we talk about a lot. I'm really excited about where the industry is heading. And they're two guys that are definitely making it possible. Before I start, though, I do want to say a big thank you to our sponsor today, Finlocker. And for those of you that might not be super intimately familiar, Finlocker attracts, builds, and nurtures customer relationships for companies. They're kind of a next generation technology engagement solution. It's for lenders, it's for originators, it's for servicers, it's for credit unions, banks, credit cards, housing counselors, all these people. Helps provide their customers with personalized financial solutions and a path to home ownership, which I actually was speaking with a guy today on my other podcast. Who works for Arrive Home. They do down payment assistance. And he threw out some stat that's like the average net worth of a renter in America is like $7,500 versus the average net worth of a homeowner is in the hundreds of thousands. So we get more people to home ownership. That's definitely a good thing. Finlocker's helping out. David, I know you're a fan of Brian View and you know Finlocker a little bit. Anything to add?
Yeah, I would just, part of my background was financial services, capital markets, stockbroker, first job. And back in the day, it was all about hawking stocks and closing transactions. And then this environment where, bid and ask was still two guys in a pit yelling at each other and things traded in quarters and steenies. I mean, that's how old I am. And so what happened was decimalization came along, technology came along, we moved from fractions to quarters. And what became really important was financial planning. So stockbrokers went from this really transactional mindset to more of a financial relationship education mindset, getting to know the customer, their total relationship, their financial profile, their hopes, their dreams, and how that kind of relays into their financial future. And that's where Finlocker really is that front door, right? They provide that foundation of educational knowledge as well as the totality of your financial picture and how that home dream fits into it. So they really are the front door to the digital experience because they're making our jobs easier in technology by educating people. We talked a little bit about compound interest earlier before the call started, and I think, eighth wonder of the world, right? And getting people to understand just the basics of financials is stuff that should be done in college. And so we appreciate Finlocker picking up that mantle and really bringing the financial education piece to the forefront. Really important.
Yes, definitely. Well, before you even get to the front door of mortgage, you see the porch light, if you will. So this might be let's do intros here. I read enough bios throughout the week. So David, maybe introduce yourself, Porchlight a little bit. We'll dive into it deeper later. And then Trent, if you could hop in and talk about your background and why you started Pylon Lending. But David, let's start with you.
Yeah, I go super quick. From financial services, you heard Merrill Lynch, moved on ultimately to Bank of America, where really was servicing capital markets. And my first exposure to mortgage was the integration of countrywide credit. One of the biggest mortgage integrations, and it was a full tech play. Our whole idea was let's bring in a loan origination system, put it in our branch offices, and bring the banking and the mortgage worlds closer together. You guys all know how that worked out. Not so good. But from that moment, became very interested in sort of mortgage and been down that path, and was still carbon copy and triplicates back in the day, and running to the photocopier to make deals happen. And as a technologist, I really thought there was a tremendous amount of opportunity there. And so spent a couple of years at some separate fintech companies trying to fix the problem and realized really that the big problem of that front door we were talking about was it's controlled by the back door. And you can do as much as you want at the front end of this process, but at the end of the day, the lender controls so much of the experience that despite how great at technology you might be, your customer experience is always handcuffed. And so we got really excited, and that's a nice segue to Trent, about having that ability to bring that front door in an technology sense and integrate it with the back end processes. And that's really the only way we can make a dent in transforming the customer experience. is bringing those two worlds together. So we started Porchlight with that dream in mind of bringing sort of the technology of the front and the back together with one sort of really key underpinning, and that we're not trying to replace humans. We still think this is a human guided transaction from both the loan advisor, loan officer, and the real estate agent. But there's a whole lot of people in between those folks that are doing technical, repetitive tasks that can be easily automated. But nobody was able to do it because they'd not taken the opportunity to bring front and back together on a single platform, put all the data in one place, all the systems in one place, and try to really transform the customer experience, realizing that humans still need to be in the loop. Loan officers are an important part of the transaction, as are the real estate agents. So that's what Porchlight's all about, really transforming that consumer experience into, what the digital millennial expects. They are not going to tolerate the experiences that exist today. This new cohort of home buyers has high expectations for us. So we're out there trying to meet those expectations in the marketplace.
Mm-hmm. And you're working with Pylon Lending, which I'm going to do a terrible job here reading off the website, but it's programmatic mortgage infrastructure for a variety of companies, fintech, banks, independent mortgage companies, originators. Uh, if you could explain what kind of that programmatic infrastructure means and how it can help scale businesses, and then also your background, that'd be a good intro.
Yeah, I'll start with my background. So before this, I built a marketplace for building custom homes online. And about 95% of our customers were asking to finance through us, and we did not have mortgage capabilities, or we were not a mortgage company. And it was the number one predictor of whether or not someone would transact on the platform. So I looked into building a mortgage business and looked at some of the really big companies who have built mortgage companies in-house, or mortgage lenders in-house. Names that come to mind would be like Morgan Stanley, Lennar, Zillow, SoFi. And across those, they had spent hundreds of millions of dollars and usually acquired multiple companies in the process. And so the immediate reaction was, we probably shouldn't do that. But the reason that it's so hard is that what we would describe as the mortgage factory problem, which is you're building a factory to manufacture collateral across processing, underwriting, closing, post-closing, QC, whatever, right? And if you look, last year, according to the Freddie Mac cost to originate study, the average lender lost $600 per loan. And the cost to manufacture was close to $12,000. And so as you're building this quote unquote factory, you're constantly right sizing human capital to match demand. And so when demand is constantly outpacing supply, meaning human capital, your economics are right sized or are positive. And when demand is either flat or fluctuating or contracting, you are upside down on your economics. And so, because when you're growing, you can just keep hiring people into the problem, right? And so that is probably the biggest challenge, aside from the fact that, of course, post GFC became incredibly regulated, the cost to do business went up, whatever. But that is sort of the core challenge that exists, is this mortgage factory problem. And at the time, we actually incubated my last business with the founder of OpenAI, and I had seen a lot of what was coming very early on before it was public with OpenAI. And so the way we think about it is that mortgages are, instead of having an automated process within your vertical SaaS or your LOS point of sale and sort of doing this incremental automation, we believe mortgages are going to API calls. And it's not that hard to believe that, because if you look at every other financial product, whether it's stocks, bonds, crypto, treasury products, they've all become API calls. It's just that mortgage has been so human labor intensive for so long that it's sort of hard to skip ahead to that point mentally. And so having now seen having seen what was happening in AI at the time, decided to go start this business. A lot of our investors had became early investors in Pylon, and it was sort of a natural genesis for the business. Now we're really focused on making mortgages fully programmatic. So building the infrastructure from taking an application all the way out to loan settlement. And we really started with the capital markets first, which is an important concept. I think a lot of times folks have focused on, one specific part of the origination process, or starting with like the consumer experience and working backwards and maybe never getting there. The capital markets are the foundation of everything that we do. And we've partnered with some of the biggest banks on Wall Street, and hedge funds, and now increasingly other capital providers across the ecosystem, to build fully programmatic rails and execution for mortgage originations.
Yeah, and I'll flex for you a little bit here. Peter Thiel is involved. And it was cool hearing you mention SoFi, because I was an original employee, and actually Mike Cagney is supposed to come out to my house and fish today. So he's so close with him, and it's cool to hear that. It has plagued the mortgage industry for forever. This cyclical nature, which everybody knows, times are good, times are bad, and the Fed kind of exacerbated that problem by making such easy monetary policy during the pandemic. And they pulled demand forward, 7-year cycle kind of into 2 years. And so we went through this boom and bust. And the mortgage industry, despite knowing how cyclical it is, it's almost like when times are good, it's a sailor on leave, drinking on shore type of thing. Times are good, I'm not worried about the bad times. However, this last cycle made it, at least in my opinion, where companies now recognize the need for efficient scalability up and down, both ways. And so it's good to hear that you are tackling that problem. But I just wonder, you know, when I first started in the industry, I got out of I graduated the University of Texas in the early 2010s, and I joined SoFi, and it was the talk of this end-to-end digital mortgage, the digitization of mortgage. And 10 plus years later, almost 15 years later, we're still talking about it. Have we finally reached the point where home affordability is so bad, or whatever is going on in the market has finally made it where it's now it's become necessity? Like what is it about now that's actually allowing for us to be at this point where we can offer this end-to-end digitized mortgage? The David mentioned the term, what a digital millennial expects. We've known we want it. Why is it taking so long to get here? David, good try. Go ahead, Trent.
Yeah, I would argue that it's what I described with the mortgage factory problem. So if you look at all of the software that's been built, it's mostly around, well, entirely around speeding up various portions of those conveyor belts, right? So can we make underwriting 15% more efficient? Can we make processing 25% more efficient? And the reality is that usually you have somewhere between 10 to 15 different systems that are interacting with one another, and they have to be converging towards the same standard or future, and even underlying data model to be able to automate everything that sits on top. And so that frankly just hasn't worked. Like if you look at what's happened in the last 15 years, despite all of these new point solutions and seemingly modern software, the cost to originate has continued to skyrocket. So I think believing that like the next point solution that you can tack onto your factory is going to save your problem, save your economics or help you is sort of a fool's errand. In our case, in order to deliver fully programmatic execution, I think there was a world where 5 years ago we could have spent billions of dollars building really advanced machine learning models. It was technically feasible, just outside of the realm of what a company could feasibly do with upfront R&D. Now it's more like hundreds of millions, and post some of what we've seen in AI. And so I think maybe the difference is that we view it as you have to solve for the entire value chain and build underlying infrastructure starting at the base, which is the capital markets, because the capital markets ultimately determine what the loan needs to look like, and then be willing to fully build a fully vertically integrated stack on top of that and spend the money on R&D required, which is not easy. It requires a lot of upfront building, and sort of doing something that is maybe semi-contrarian relative to the mortgage ecosystem of everyone plays their individual part. But I think that's what's required to really solve the problem.
Yeah, I'll just add to that. I think of simply, Robbie, the Web 2 missed this space. We spent a lot of time talking about AI and all, machine learning, and the reality is there's still no viable Web 2 platform for real estate. And you have to ask yourself why. And
What does Web 2 mean
Web2
for
just
people?
HTML. Let's do an e-commerce platform. I want to buy and sell a widget, eBay, your basic transactional platform. And you could take this mortgage problem to a Stanford, computer sciences class and they could fix it, right? But what they would find is when they go to implement, why won't it work? And it won't work because the capital market guys aren't on board. And until the guys that control the pot of gold, the guys that buy 80 to 90 to 96.5% of the house are on board, no technical solution is going forward. So a lot of what Trent's doing, technically is important, but it's also cultural. He's wrapping these lenders up and getting them to trust him, right? As being their guide, having a single repeatable process to access multiple lending sources. The way you use your credit card at eBay does not differ from the way you use your credit card on Amazon, right? But mortgage, you have 5,500 different processes to access different lenders, or really there's 1,400 big ones, but about 5,500 independent registered ways. So when you're a real estate agent or a millennial going to buy a home, the process is never repeatable. Each transaction is different because in order to access that guy's checkbook, you need to follow his process. And so what Trent's really done is herd the cats, right? He's put a bunch of lenders behind a common unified process and then made that accessible by API calls. That empowers a guy like me to go out and not worry about that piece and focus on the consumer experience and build on his infrastructure, a way for you to transact to purchase a home that is agnostic of the lender's processes. And so as a real estate agent or as a home buyer, my experience becomes very uniform and consistent and not dictated by the person that's actually funding the loan to purchase the home. And so that, beyond the technical side, there's a lot of what Trent had to do is get these lenders to agree and be culturally on board with this idea because it's somewhat threatening to them.
Yeah. Well, I think we're discussing there's two kind of big problems here or issues with his, legacy issues. And one is what you mentioned in your first answer, David, and subsequently just now, and Trent mentioned in the second answer, and that's capital markets. David said that the capital market essentially determines what the loan needs to look like. The other problem is the human element, which leads to certain inefficiencies or drives up costs. And I'm not advocating for taking away people's jobs here. I'm advocating for people being more productive through technology. Let's make that distinction. But let's address each of those problems one by one. David, your background is in capital markets. We've seen kind of a shift where capital is now more open to new products or underwriting methods, whatever it might be, incrementally and slowly. Uh, I've said for a while, historically, the industry has been very good at finding debt obligations, but not good at finding income sources. I might have a small home in the woods here, but they don't want to use that income, unless it meets certain parameters, whatever it might be. Can you talk about capital markets becoming more accepting of kind of newer products, newer ways of originating, how we're going to see kind of the mass shift if it's a bell early adopters, whatever it might be, kind of where we are now and how you see it evolving through the remainder of this year and into the next couple of years?
For sure. And it's happening quicker than people think. So when you look at the GSE, in fact, my Chrisman newsletter today has a very nice piece about the GSE privatization that's going on. But, touching on sort of private credit as a totality, it went from a $400 billion marketplace to 1.8 trillion in private credit. Those guys are clamoring for access to good paper. Right. And let's take a flip side to the GFC is this regulation has created a portfolio of paper on the marketplace that's near treasury quality. I mean, the underwriting standards and the regulation has a positive byproduct to capital markets, and that the paper we're all selling on the back end is pretty solid right now, more solid than it's ever been historically. So, this GSE privatization, is it going to be 50 basis points higher? It might be a nothing burger, right? We might actually see capital markets move to a more privatized model, create more competition. I'm a big free markets believer, that, we might not see that 25 or 50 bips hit, and that private credit might step in and fill the void, because the paper that we're writing is really high quality. So I think there's, a transformative time in capital markets. And if we can give them visibility to underwriting standards, visibility to overlays, then the shopping experience for the back end capital market guys trying to roll up mortgage-backed securities, they've got, a lot more faith in what they're looking at based on, the systems data that Trent's back end is providing them. When they're shopping for paper, they really can run their scenarios and their filters and build their portfolios in a programmatic way on the capital market side. It's pretty exciting, Robbie.
Yeah, and Trent, I want
Well,
to talk some, bring us in to some of these discussions you've been having with capital providers and how you've been able to convince them that, this is great paper.
think about it historically. So if you want to spin up a new loan product in the capital markets, what do? You go develop your guidelines. You maybe you do it in concert with some of your originators who want to support this product, or maybe it's coming from demand from a specific originator that you want to go do this with. And you then need to go train the underwriting staff on underwriting against those guidelines and effectively ingrain the same tribal knowledge that they're using today to underwrite like a standard conventional conforming loan. Most underwriters aren't looking at the guidelines when they're underwriting a conventional conforming loan. They know them, and so same thing goes for these custom guidelines or new products. You need to train them, and then post transaction, you're typically exporting a file, throwing it over the fence to the takeout or the buyer of the loan. They're going to re-underwrite it or due diligence it, and you're hoping that you're correct. And on a new product, there's a big hope factor because you have not yet trained your staff through many years of experience, and so there's a lot of risk involved with rolling out new products. And in our case, we can effectively ingest any set of guidelines from the capital markets and then programmatically execute against those guidelines. And so we don't go through that same process of needing to train this underwriting staff. We also don't go through the same process of lobbing it over the fence at the end due to what we've built with the capital markets. And so an example of this is I can't yet share the details. It'll be on them to share, but we are working with a publicly traded company who is rolling out a very new, exciting product. And it turned out that one of the banks on our platform was really interested in supporting that. And so they produced a set of guidelines for that originator. We were able to support those guidelines in a matter of a few days. And now that originator, that publicly traded business can go roll out this product effectively with zero overhead from their perspective. They also don't have a factory themselves. They're building out a handful of loan officers to go support this business and relying on our programmatic execution to handle everything else. And so you've effectively cut down what is normally taking months of build out in your LOS, setting up all sorts of rules and conditions, training the staff, and effectively eliminating all of that. And so I think part of the question here is like, what is the substrate that is enabling new products? Because as it stands today, you have to have a lot of volume and a lot of confidence if you're going to go roll out a new set of guidelines, if you're one of the big capital markets players. If you're not, if you're a small balance sheet business, you might be willing to do it for lower volume amounts. But your cost of capital is normally going to be higher. And so the ability to roll these new products out at scale with the largest buyers of loans and institutional capital markets is really important.
Yeah, I remember working on a capital markets desk at SoFi, and our originators would come to us and they'd say, we want this product, we want this product. And we go through credit committee and all this back and forth and finding an outlet for it. And then we do 2 loans every 6 months type of thing. It was like, what the heck are we doing here? I know, yeah, it's not quite what you're mentioning. You're mentioning more on kind of the back end, larger institutional scale. There's got to be stuff for it. The other part of what I said is about the human element here. And I think that's important. There's been talk of disruption for a long time. And maybe originally it was, hey, let's displace the real estate agent. And then we realized, hey, people want to be, walk into a house and have somebody hold their hand and tell them about the school district, yada, yada. Then it was, hey, let's disrupt the originator. Their comp is crazy, and a lot of this stuff can be answered through an AI chatbot. Well, it almost seems now we move past that to, well, the underwriter and the processor are the ones that can be disrupted. And I'm I guess, David, I want your thoughts on if you think that's going to be where we stick, or if we're going to evolve to other parts of the process, where you see the biggest efficiencies coming from a human capital element.
Yeah, it's a great question. I mean, there's two sides to production, right? And there's production of the loan file, there's a production of the transaction that goes on the real estate side. And so the two roles that, and let me give you first the backdrop that we believe this remains a human guided transaction, that there will be humans in this transaction. It's too big of a purchase to be completely programmatic from the real estate agent side as well as the loan side. There's always going to be the need to have some human in there to give you that level of comfort that the biggest decision in your life, right, is a sound one. And I feel pretty good about it. Maybe someday this cohort, maybe showing my gray hair a little bit, will be very comfortable talking to an AI agent that says this is good to go. But I don't even trust AI right now on some of the things I'm using it for. But it's getting better every day. So I maybe dating myself a little bit. But
No,
the
I call up an airline and I'm like, representative, representative,
That's right. That's right. And so, but we can change the role of those. So the two people, just to be, totally transparent that we're after are the processor. The loan processor is a Boolean person that is, taking guidelines, trying to translate conditions, get those conditions cleared, translate those conditions to meaningful responses from a client, right? That's the perfect use case for AI. We're not looking at AI doing any underwriting, but that kind of Boolean conditional clearing and translation is perfect. The loan processor is going to be dramatically impacted by the future. On the real estate side, they have a very similar guy called the transaction coordinator. He sits behind, 10 to 12 real estate agents and shepherds paperwork around, applies the same level of Boolean logic and or condition clearing, whether it be a cracked foundation finding or an appraisal finding or some other deal. That person also, is going to be displaced. It's just a fact of life. If my kid was in either one of those two jobs, I'd be saying, look somewhere else. The loan advisor role is going to change quite a bit in that they, maybe a good guy's handling 4 to 5 files a month. That job needs to move to 30 to 40 files a month. And one of the things we can do is sort of segment their job a little bit, remove a little bit of the sales pressure and transform them to more of an advisor, somebody who has a fiduciary responsibility to their client, not somebody who's transactional and looking for the best YSP to try to move this product onto their person on the other end of the phone. So rate transparency, pricing transparency, enabling loan advisors to act in the capacity of a fiduciary is what our tech platform is all about.
Before I bring Trent in, you speak with such certainty, and I won't say hubris, but we've thought that we could disrupt roles before. Are we already at the point where these roles are being disrupted that gives you the confidence to say that? Is there any margin for error? I could be wrong here with how it's evolving.
So we are in other domains, right? So my hubris is seeing it being successful in other domains, but that is why mortgage is the way it is today. People with my hubris are dead all over the place in this mortgage journey. But it takes a
Yeah,
certain level of bravado to tilt at the windmill. So I've got a Don Quixote complex for sure. But I think it's worthy. And what's driving me is that I don't believe the millennials will tolerate the experience, right? Today, you and I, like, we're still okay. We'll deal with it. Yeah, we'll fax it, whatever. But the new cohort, this 25 to 40-year-old group of people that is entering the consumer experience for the first time of buying a home, they will respect and maybe even pay a little higher rate if the consumer experience and the cleanliness of the execution and it's on my phone and everything's in one place. It's not just rate. It's service, it's product features, it's all these things bundled together in a really experience. It's trust, right? My loan advisor is giving me the right advice and counsel on this mortgage. And all of that bundles together to be a really unique opportunity to take another shot at the windmill, Robbie. And I wouldn't be doing it without Trent. Because I realized the pot of gold, comes from these lenders, and that's why nobody's fixed this problem to date because Trent's piece didn't exist.
Yeah, Trent, thoughts on the human side of things, and then also kind of what David mentioned with the gap y'all are filling that makes change truly possible.
I mean, yeah, the entire foundation of our business is making the origination process a set of API calls. So I very much deeply believe that what we're talking about is possible. And I do think you have to re-underwrite your priors. I agree that a lot has been tried in the past, but we have this fundamental platform shift that has taken place, and I do think it requires rewiring the entire value chain versus a portion and hoping that the next guy does their job too.
Real
That
quick,
said,
what does an API call mean for people that might not know on this?
oh, sure. So yeah, I mean, so let's a good example of this. I liken where we are in mortgages today to what payments looked like prior to Visa. So before Visa came along, every merchant was handling their own payments. There was a lot of paper involved. People were buying software products at the time, very early software products, or to process these payments in a localized fashion. They might be working with local banks. And then Visa came along and effectively built a standardization layer or a network that is accessed now through API calls. At the time, the technology was a little different. When you go and buy something online, there is an API call, which is application programming interface, but is the textbook definition, but it basically just means software that does not have a user interface that you're clicking a button on. So something is happening in the background, and you're making that API call to the payments processor, which is then using the underlying rails or network. Usually, Visa, MasterCard is actually processing the transaction under the hood. There are lots of folks involved, but ultimately payments have become this API call driven business, as have the other financial products that I mentioned. And so today, again, the initial thought process is, how do we go incrementally automate portions of what's happening? But I actually think that is sort of not doing that re-underwrite of the platform shift. That is believing what has happened for the last 10 to 15 years. We've been in this incremental land. And again, it hasn't worked. So we see going to this future of API calls where you can hit the API, get an underwriting decision, and effectively have these fully programmatic or instantaneous transactions. Now, the regulation also has to catch up with that, because today you could have a fully programmatic origination, but you would still be sitting there for the TRID timeline, which sounds really silly when you think about it. And so that we'll continue to see, and fortunately, I think the current regulatory environment is leaning more aggressive, but I think we'll continue to see the regulations or catch up with the underlying capabilities.
I agree that regulations will catch up with the underlying abilities. It's going to be so. Go real quick and then say what you're going to say. I've heard AI companies say, "Don't boil the ocean." Find things. And so you're saying, let's boil the ocean, throw the baby out with the bathwater. I'm already doing this. We can do it. Which is, I'm excited to see which philosophy wins out. But please go on. I interrupted you.
Well, it takes multiple years of building and looking slightly insane to pull it off. So yeah, we could talk more about that another time. But yeah, back to the question of AI and where things are going. The real answer is that nobody knows for sure, right? We're all making bets. But I remember a couple years ago when this was first emerging as a hot topic, and I heard a lot of people talking about automating, like chatbots and automating portions of what loan officers are doing. And at the time, I was like, there's no way this is the most valuable application of AI. Per what David was saying, they're ultimately that is the most valuable part of the entire mortgage transaction, is the people interfacing with the borrower. In an ideal world, we would love to go free up all the people doing remedial back office work to go spend more time with borrowers. And I don't think any borrower leaves a mortgage transaction thinking, oh, that person who was on the collateral desk underwriting the appraisal really pulled through for us. And so I think there's a misconception of people, sort of what happened 5-10 years ago, people's focused on digitizing the upfront application process. That same thing has happened over the last couple of years, where a lot of people have been focused on applying AI in areas where either don't really matter or are maybe the opposite of where we should be focused. I think that's starting to change. But now it's sort of changing into this like incremental version of how do we automate portions of what people are doing. And so the tricky part is that if you can't just throw a mortgage at an LLM today and say underwrite the mortgage. We all know that no one can trust those outputs. And so the real thing is you have to build comprehensive systems that allow you to get to accuracy 100% of the time, because you can't be right 90% of the time in the mortgage industry. So that's where the real value comes into play is those who are spending time, which requires, frankly, a lot of resources to get to 100%.
Yeah. David, do you want to address Alan's question in the chat? Trent thinks APIs are going to take away underwriters. You say underwriters aren't going away. What is the balance between those two?
Yeah, so they aren't going away anytime soon. It's really a regulatory burden. The capability of like deterministic machine learning is going to replace underwriters at some point. But until the regulators are comfortable with the black box and you can explain, why all these plumbers are being rejected from mortgage because AI figured out plumbers don't pay their loans, or it's redlining, or whatever, until you can describe it like to the regulators, the sense of confidence, that's what the barrier going to be. And you can't really go out and just build your data set by playing, right? And it's redlining all over the place and doing all this stuff. And so you can't train your model on real people. So over time, we have all this data. We will train models. Underwriters will become more efficient. They'll still need to be the check, but it's the perfect use case for AI, Alan. It's just the regulators aren't going to let it happen anytime soon, so it's not an area of focus for me. Because despite how brilliant a technologist you are, the Fannie Mae cash window is not going to take your file.
Yeah. David, I want to give people some background on how we got hooked up. And you've listened to my podcast for a while and you heard me talking to all these AI people and you're like, he gets it. What I have said for years is why doesn't a marketplace exist in mortgage like we have for Google Flights? There used to be these travel agents and you call them and say, I want to go here, and they compare. Nowadays, I type, SFO to John F. Kennedy, boom, up pop all my options from all the airlines. I go shopping for car insurance, up pop all my options for car insurance. I go look for a hotel on Expedia or Hotwire, up pop all my options. And obviously underwriting a mortgage is a little more complicated, but and there's barriers we've seen with, do lenders really want to put their rates up against their competition publicly? I'm wondering kind of if you could bring people up to speed on how your and my visions of the future of mortgage dovetail and why it hasn't gotten there just yet.
Yeah, so that the travel agent analogy is a good one in that, the mortgage broker sort of plays that role. The difference goes back a little bit to what Trent was hitting with Visa. Visa's already underwritten, right? So when you go to make that transaction, there's no underwriting going on. The airline's just trusting that Visa is going to take care of the whole thing. So it's not the perfect metaphor. This underwriting occurs in two flavors. We have to underwrite the person. We also have to underwrite the collateral, right? That's backing up the loan. So it just muddies up the ability to make a smooth and elegant transaction. But the one I want to build on that you're hitting on is rates, and the inability for people to display rates in a way that allows honest shopping to go on, honest comparison to go on. And the reality is bankrate.com, isn't really serving a lot of value to a lot of people because, nobody's realizing that's a fake rate, right? That rate isn't my rate. That's my 780 credit score. I work at NVIDIA. I'm putting 22% down. That rate isn't real until we underwrite you. We don't know what your rates are, right? Until we see your collateral, we don't know what your rates are. And so rates become a really hard thing to be transparent about. And so the idea behind Porchlight is to bring that transparency forward. Let's move some underwriting tasks to the front. Let's bring the collateral data into Trent systems so that we're seeing the collateral and the person in real time. And we're beginning the underwriting journey a lot earlier to get a sense of what we call sharper rates. The more information you're willing to put into Porchlight, the more certain I can be about your rate. But this goes back to sort of the Finlocker stuff, right? This Finlocker idea of realizing that the rate you see in the paper isn't real, right? They're educating you on your credit score, how to repair your credit, how a 720 to a 740 means a quarter point on your mortgage, right? It's a big deal. And so here's the steps you should take to prepare yourself for the home transaction journey. And that Finlocker sort of value prop on the front end allows people to understand when they're using a system like mine. Well, that's why I see 7.5 in the newspaper, but I'm 7.75, and I feel good about that. Like I'm not feel like I'm being taken to the bank on rate. So bringing rates to the forefront, Robbie, is something you've been preaching. In this marketplace environment is the only way to shop and compare. So the question about why doesn't exist, gets into sort of like maybe they just don't want it to exist.
Yeah, there's definitely been some gatekeeping in the industry. Trent, you look like you want to say something before you get to that. Everything should be further forward in the process. Rocket Money's been making this play Rocket's been making this play because they have Rocket Money. They have all this data on consumers. Plaid data exists out there. These APIs exist where we should be able to underwrite you earlier in the process. We should be able to pull home insurance forward in the process, title forward in the process. That to me,
AUS.
yeah, all that stuff forward in the process. Trent, I do have a final question for you, but any thoughts on what David just said?
Oh, well, back to the point of automating underwriting, David, I respectfully disagree with you. But we, as a customer of Pylon, I will happy after this call or later to show you some stuff that you will benefit from in that direction. And we'll see about that. But the thing I feel like we're kind of right now at a healthy debate. We're debating the inputs of the things that, like, we're talking about the experience to the borrower. We're talking about automating underlying back office work. At the end of the day, borrowers don't really care nearly as much about either of those things as we like to believe they do. They really care about the rate. And so, everyone I think everyone likes to talk about everything else because they don't control the rates. Right? The capital markets control the rates. The Fed controls rates. I'm talking about the end originators here, not the capital markets or people running mortgage banks. But from our perspective, the reason that a big part of why rates are the way they are is not just whatever the 10-year is saying tomorrow, but rather all of the middlemen that exist in the capital markets. So if you think about a wholesale lender, for example, they are taking rates. The top, there's a power law. The top wholesale lenders have access to the best capital markets because they have the most volume, right? And they are taking those rates and they're marking them up. Usually anywhere from 40 to 200 basis points. And as rates improve, those spreads continue to blow out. And the reason they have to mark them up so much is because they have this factory. They have tens of thousands of people that they employ, millions of square footage of office space, or at least hundreds of thousands. And they need to go pay down those costs and whatever margin they need to operate, either as a publicly traded business or as a private business. And so I think that what we're talking about with automating underwriting, eliminating the factory is actually just an enabler to go bring down the cost of rates, which is what borrowers really care about. And that's why, like, for us, we started by saying, how do we go strip out a lot of the middlemen involved in this transaction? Let's go directly to the securitizers and pass those rates through directly to an originator. So David today on the platform can go price a loan directly to Citi's mortgage trading desk, for example. We don't add any margin in between. And we can dramatically bring down the costs by eliminating that factory that sits in between. So I don't know, I'm sort of talking our own book here with how we think about it, but I think that irrespective of if you believe that our approach is the right one, the more important takeaway is that we should probably focus more on how to bring rates down systemically as opposed to better experiences. I don't disagree that those things are important, but they're sort of important at the fringe.
Yeah, and I will agree with you that it seems like everybody has their hand in the pot, taking some, and the borrower is the one that loses. If I buy $1 million house over 30 years, I'm paying $1 million in interest, and that's getting divvied up here, there, and to line other people's pockets, or buy professional sports teams or whatever it might be. I'll disagree with you slightly on semantics, and I would say that I think the uneducated borrower cares about rate. I think the educated borrower these days cares about payment because we'll see that a difference in eighth or a quarter in rate is a double digit thing a month versus what's my property tax, what's my insurance premium. Those things are making a much larger difference these days. And so I think educated borrowers out there, and I think good loan officers that are advising their clients are saying, let's focus on the overall payment. And granted, with stripping out a lot of this middleman, we will see that come down. I do want to give you last word. You're not going to have time to disagree with me on what I just said, but I will give you the last word.
I agree with you, actually.
Okay. Good. I kind of wanted, to put this all, wrap it up holistically here. What does it take for, mass adoption of what we're talking about? Is there a tipping point? Because obviously there's, the bleeding edge has been happening for a while. When do we get to kind of tipping over to where this becomes more mainstream? I'd like both your thoughts on that to close.
I'll jump in first because that'll give a little more controversy here and disagree with Trent a little bit on the customer experience being a trusted customer experience, right? That Airbnb style experience that allows me to access all this wonderful stuff that we're building that I trust. So I think it's just, I'll be real short, Robbie. I think it's a really important component is a trusted customer experience for shopping and comparing. And then just adding to your variable, the cash to close component, right? These are things I want to play with. I want to play with my rate, my monthly payment, and how much money I got to put on the table to close. I want to have an experience to dynamically model with that. And that's going to, translate into consumer product that I ultimately buy.
Yeah, David, I'm probably looking at it through the, maybe the internal Pylon lens. I certainly agree with you. I guess the point I was making is if you have an awesome experience, but the rates are really high or the monthly payment is really high, it might not matter. But if you have strong rates and strong ability to go structure high quality loans, and then you deliver a great experience on top of that, then it's very powerful.
Yeah, we're selling a commodity. Yeah, we're selling.
This is where we work really well together. You can go build an amazing experience on top of our APIs, and we can make sure the rates are low.
And customers will win.
Yeah. Historically, it's been product, price, service, pick two. You can't do all three. It sounds like we're getting to a place where we might be able to do all three, which is really neat. Trent, I'm not going to let you go without answering that question. Thoughts on when this will become mainstream? What will push it over the edge?
Yeah, well, I think you never really know what's happening until you look back in history, meaning like the change that we're undergoing as an industry now will be obvious like 5 years from now, and we'll look back at this, right? So it's always tough to say in the exact moment, but I do think that I'll leave it at this. I can't predict with a crystal ball how the market converges. We're making a pretty big bet that we converge into this programmatic future. And the lack of change in the mortgage industry over the last 30 years, in my opinion, is directly proportionate to the change that we will see in the next 5 to 10 years post AI. And some industries are not like payments, as an example. They're already so efficient that there's actually not a lot of room for efficiency. Mortgages are so inefficient that there is an incredible amount of room. So that's the bet I will make. The exact timing and sequencing of it, I will leave to the market.
Yeah, and I'll tell you in 5 years, we still won't have remote online notarization adopted in all 50 states because of regulation. So good luck to all of us. No, I really enjoyed the discussion today. I thought this was fantastic. Trent, it's a pleasure to make your acquaintance. Hopefully this leads to more discussions amongst us in the future. David, always a pleasure seeing you. So I wish you both the best of luck in what you're doing. Big thank you to Finlocker.
Thanks, guys.
And we'll see everybody next month.
Bye.
Thank you.